pension funds, insurance companies, etc., investors, investor groups. So over the life of your loan is going to be bought and sold multiple times. And so you usually in that cycle on the second or third or fourth sale is when smaller investment companies like ours kind of hop in and are able to, get some pickings and pick up a few notes to purchase. Usually we go after the non-performing ones, and we go after the ones that are in junior positions. So if you have two loans on your property,
Yeah.
there's a senior and a junior. So the junior, the second, is what we usually invest in. That's kind of our niche. We invest in the second non-performing loans. So that's kind of our niche that we've chosen.
Mm. So then, to do you need to be certified to be able to purchase notes and all that?
Nope. So just like you don't need to have a real estate license to flip houses, you don't need to be certified or have any kind of license. Now, if you are servicing your own notes, that might depend state by state. They have their own criteria. If you're originating notes as well, which means that you're the one that's lending the money, then that in that case, it goes state by state. You most likely will have to be licensed. Um, but if you're just purchasing notes that have already been originated, anybody can do that. A lot of people with 401ks, pension plans, et cetera, they like to have, some stable cash flow. It's uh, it's secured by a real asset,
Yeah.
and so they'll purchase one-off notes or, a package of 5 or 10 notes to put in their, 401ks, et cetera. So that's what we kind of do.
Do you so when you and your partners, you guys kind of get in on this, like, do you guys just kind of bring in all your cash together, buy a bunch of notes? How many notes do you guys buy like per transaction?
So we started off small. I think the first portfolio we purchased in 2019 together it was a portfolio of 24 notes that were all non-performing. So these borrowers hadn't made payments since like 2013,
Mm.
and their loans were sold to multiple companies until it kind of landed in our lap. We underwrote the portfolio, looked at the assets, looked at the real estate, made sure the values were there, picked out the ones we wanted, and we purchased 24 of them. And so that portfolio went really well. And so what happens with these is you can, if you have the cash, um, purchase the portfolio yourselves as investors. But what we'd like to do is we like to raise the capital from other investors, just like any other fund. Like if you're a multifamily fund, you're syndicating it, you're raising the capital, you're doing investor splits, you're offering a preferred return to the investors, and that way you have more purchasing power. So, for example, we started with 24 notes, and today we are now looking at our first bigger portfolio of 92 notes to
Wow.
purchase. And we wouldn't be able to do that if we didn't have investors, where we raise capital from them. So,
So you said that you guys are getting one of your biggest portfolios now. How big of a loan are these notes? Can it range? Is there a minimum, like maybe 20,000, 2,000,
it
three
really,
thousand?
yeah, it really varies, especially like because a lot of these notes, like some of them were originated in 1996, so they only have a few years left in them. So their balance might be like $12,000 left, and
Mm.
then you have others that were originated maybe in 2007 or 2012, and so obviously those are going to be a lot bigger balances. So I would say the average size would be like 50 to 75,000. These notes have been in play. They've been originated for a few years now, at least. We rarely purchase. I don't think we would ever purchase notes that have just been originated like in the last few years because with our strategy, it wouldn't make sense. So
Can you share a little bit about that strategy?
yeah, so like I said, we purchase second notes, which are non-performing. And so what we do is there's two things. One is called the principal balance of the loan. So as you make payments on your loan, your principal balance gets paid down. Then you have interest. So if somebody hasn't been making payments on their loan since like 2012, you're going to have all those years of accrued interest.
Mm.
So what we do is when we make a bid, we base it off just the principal balance. So I'll give you an example with just some arbitrary numbers. Let's say you've paid down your note for 5 years, and now your balance is $75,000 on the principal. Okay, and let's say you haven't made payments for 2 years. Now you have, let's say, like $20,000 in accrued interest. We're basing our bid at like 90% or 85% of just the principal balance. So that way, when we purchase that note, we're automatically stepping into equity. That $20,000 that's accrued, that's on top of, that's like the icing on the cake. So we can, when we do a loan modification, which is our goal, that's our main strategy, is to get these notes reperforming. Um, when we do a loan modification, we'll take that full balance of 75 plus the 20 that's accrued and do a basically kind of like a brand new note, if that makes sense. So you're kind of stepping into equity. I know it's a little bit complicated
It
with the number
is.
stuff, but yeah, you're basically just like a house. If you were to flip a house, you're kind of stepping into equity. So you want to purchase a house that's going to be worth 250 after you fix it up. You're not going to purchase it for 240. You're going to purchase it for like 180. And you want to be able to. Your ideal situation is you purchase it for 180. If you want to sell it as is today, without any fix up, you want to have a little bit of margin where you could sell it to another investor for 200. So that's what we're kind of doing, if that makes sense.
No, no, no. That makes a lot of sense. So of course it's actually flipping.
Yeah, I mean, you can have the end goal of flipping it to another investor once you get the loan reperforming. So once we purchase that note, we contact the borrowers. A lot of the time they don't answer.
Of
Um,
course.
so what you have to do to kind of light a fire under their butt and let them know that, hey, this is serious. You could lose your home, which is not our goal. We don't want to do that. A win-win situation for us and the borrower would be that we do some foreclosure prevention. We do a loan modification. That way, we can get our return on our investment. We can have the cash flow. We can pay our investors, and then the borrower gets to keep their home. And a lot of times, most of the time, I'd say 90% of the time, the borrowers are very happy to get their payments started again because they haven't made payments on their note. They know that they have a loan on their house. They could lose their home. They haven't been able to get a hold of the lenders because this note's been selling and transferring to random companies and servicers. They don't really know. Their note is kind of in limbo land. So a lot of times they're very happy to hear from us and like, oh yeah, my loan is still alive. I want to do something about it. I want to restart payments. And so what we're able to do is we're able to lower their interest rate, reduce some of the principal balance, or reduce the accrued interest that they have. Find a win-win situation where they can have some monthly payment that makes sense for them, and we can also hit our returns.
Man, that's so crazy. So like right now we're like in a pandemic, right?
Mm-hmm.
Is that affecting your business at all right now? Flipping notes?
Yep. A lot of borrowers that were making payments before the pandemic, like when we purchased like the non-performing notes back in 2019 and 2020, those borrowers stopped making payments. So we had to, recast and redo loan modifications again. We had to do forbearance plans. On top of that, there's a moratorium on evictions as well as foreclosures. So
Yeah.
people that don't want to pay there, a lot of people do take advantage of it as well.
Right.
So if we have to foreclose on a home as a very last resort, sometimes we're not able to because it's county by county, state by state.
So I'm a little confused because like if the banks are selling these non-performing loans to you guys, investors, aren't they losing money because they lend that money out to borrowers, of course, and they're expecting that to be paid back when they're selling it to you guys?
Well, they've made money from X amount of years that they've held onto the note through the interest, and then also it's calculated. And third thing is banks are not in the business of owning homes and
Right.
doing REOs. They lose money. They lose more money doing that than if they were to just package those loans off and sell them, and then that they can recast their money and do more new loans from there. So it's all part of their game plan. They know when they underwrite loans, they have very stringent underwriting. You know that from, only certain clients can, get approved for a loan, based on their credit score, et cetera. So with that in place, they have everything calculated out. They know how much um, they could lose. So like they'll have that gap, that wiggle room when they're underwriting these notes. That makes sense.
No, that makes a lot of sense. You know what I just realized, Sign?
Yeah.
When we were doing the whole introduction, I was doing the whole market update. I did not hit live. So like I just hit live like about 10 minutes ago, and now everything's running by, and I was wondering why people are logging in, they're logging out. So I apologize if you guys are just logging in right now or 10 minutes ago. Um, I see Georgina's here. She's saying hello. She's from the Bay Area. I'm so sorry, but I'll do a quick introduction, okay? So I guess we have Saim here today. Saim Chaudhry, he's an investor. He used to flip houses, but now he's flipping notes. Okay, and because we just came live, I just hit the live button like 10 minutes ago. I apologize. I'll do a quick recap of the market update for you guys real quick, so that way you guys can see what's going on right now in all three counties. Okay, so Saim, just hold on real quick.
No problem.
Okay.
Oh man, make sure we're
I
live this time.
Oh no, we're live this time. God, I feel horrible. All right, so this past week, there's been about 376 homes that sold, and me and Simon were just talking because look, here's how many homes that's available for sale right now. It is so crazy, you guys. There's 110 homes that are for sale right now in three counties: Sac, Placer, and El Dorado. 110 homes.
That's crazy. Inventory is low.
Inventory is so low. If you're a buyer right now, this is why competition is so high. This is why it's so hard to find a home right now. This is so stressful. I feel the pain because I'm out there showing homes every day, sign.
Yep, yep.
So like I feel it. That's the market for you guys right now. The weekly market update.
And we were talking about the days on market, how we were seeing it drop. Like you usually you can find homes on the market for that have been on the market for 30, 40, 50 days. Now those are pretty much all wiped out. All the houses are 0 days, 1 day, 4 days on the market. It's crazy. It's
If
sell.
if the home's been on the market for like close to 30 days, something's really wrong with it.
Yeah, yeah,
Number one reason, most of the time that home might have a tenant.
that's true.
And right now, buyers don't want to buy a home and then having a 50-50 chance of evicting that tenant out when there is no evictions going on right now.
Yep, yep,
So
yep.
that's what's going on. But can you do a quick introduction again, bro? Because
All,
because
did,
you
did we
you like
miss all
me
the
and
questions
you.
as well,
Well,
or
what happened?
did we miss all the questions as well?
We did, man.
Oh man.
I know it was so bad, right? I feel bad. It's like 13. We've only been live for like 13 minutes now, but you and me been talking for 23 minutes now.
Oh man.
I know. I feel bad. I feel
It's all
so
right.
bad because it's so confusing this time. They changed the layout on the studio, so like it's so different now. But anyways, like, can you do a quick introduction
Yeah,
again?
of course.
Like, because I knew you from real estate. You started off as a real estate agent at HP, and then you transitioned to full time real estate investing. And so like now you've transitioned to buying notes. So talk about that. Why did you transition into flipping notes instead of flipping houses?
Yeah. Okay. So yeah, my name is Simon, and I got into real estate back in like 2012, and I got my agent license, and then I got into flipping houses from there. And then in 2019 is kind of where I made the jump into investing in notes full time with two other investors. So these two investors, they also flip houses. They're full time house flippers. They still flip houses. They still do deals. And don't get me wrong, I'll still look at a deal as well. A deal's a deal.
Yeah.
But yeah, so 2019 is when we started doing full time, basically investing in notes, which is investing in loans secured by single family residences. And the reason we got into investing in notes and kind of switching out our game plan and our business plan to do that full time is because the market's just been getting too hot. As you can see, we just talked about the market update. It's there's no inventory. The margins are very slim. They're getting slimmer. It just doesn't make sense to flip houses anymore. I mean, you could still find good deals. Don't get me wrong, and you'll always be able to find good deals. But the market's just way too hot right now. And a big source of inventory for flippers is auctions, and you're good luck getting a deal at an auction right now as well. So
I was talking to somebody the other day. They came in commenting on one of my videos saying, because the title of the video is "Don't Buy Auction Homes,"
uh-huh.
and I think an investor came on and he was like, "You're stupid. That's bad advice. I make all my money buying homes from auctions." And I commented back. I was like, "Not a lot of people have cash like you. If you're buying homes from auctions, that's great. But majority of homes being sold at auction right now are not financeable."
Yeah, I know investors that they purchase, all they do is purchase you know auction houses, and they make really good money. But they have systems in place, and for them to purchase, like, pick up like 50 properties a month, in California, all over California at auctions only, they've got a team, they've got a system in place. They've got all that stuff built out from before.
Right.
So, and another thing is there's all these foreclosure moratoriums right now, and
Mm-hmm.
eviction moratoriums. You can't evict anybody, and you can't foreclose on a home right now in a lot of places as well. So it's tough.
So that's why you transition into notes.
Yeah, and it was you got to evolve with the times, you got to evolve with the market, you got to adapt. So that's what we've been doing, trying to do at least.
So you started it in 2019, and
Yeah.
you got introduced to it by some investors.
By
How
these
did
two
you?
investors that I work with, yes,
And so that's all you do now.
pretty
Majority
much
of your
full time. That we just invest in notes. We look at portfolios every month to purchase. We maintain our current inventory of notes on our borrowers. We do loan modifications with them, and we're raising capital for new funds, for new loan funds. Back in 2019, our first portfolio that we picked up, we cherry picked out 24 loans. They were all non-performing, and so now we've worked our way to where today I actually looked at our first big portfolio of 92 loans that we're looking to purchase. So we've we've kind of grown since then, which is great. So
92 loans.
yep.
How would let's say somebody wanted to start buying these non-performing loans. First of all, what is non-performing loans?
Yeah, so there's two types of loans. There's performing and then there's non-performing. So it's basically just what it sounds like. Performing means that the borrowers are making their payments on their loans. So when you buy a house, you get a loan from Wells Fargo, from Bank of America. If you are making your payments on time, those are called performing loans. If you stop making your payments, those are called non-performing loans.
Mm.
And what these banks do is usually 99% of the time, within a few months of you getting a loan from them, they'll sell it off to, pension plans and pension funds and hedge funds and insurance companies, et cetera. So the big boys have a seat at the table with these big banks, and then over the life of your loan, it will get sold and transferred multiple times, and you might just not know about it. So there's a huge market for loans and notes that's going on in the background.
So when you say they're being sold, is it similar to when, like, let's say I'm assisting a first time home buyer and they probably got assisted through like Mountain West or a new lending, and then when they get the home, it's actually Flagstar that purchases the home. Is it
Yeah,
something like that?
it's something like that. So what these lenders will do is they'll package all of their loans into performing and non-performing, and then they'll sell them off. Usually, the first time it's sold is to big companies, big hedge funds, because these guys are doing millions of dollars worth of transactions with these big banks like Wells Fargo and Bank of America. Just like you would see, like, big hedge funds purchasing REOs from these big banks. It's kind of similar. It's the same thing.
Like
So,
Blackstone.
yeah. Deutsche Bank, Wells Fargo, Bank of America, they're all selling to these big hedge funds and large investment companies. And then from there, they'll break them up and a few years later sell them to other investors in smaller pools. Because a lot of those loans might get paid off. People refinance all the time. A lot of those loans might reach the end of their life through maturity. And some of those loans the investment companies might decide to keep because they're good cash flow for them. So they just every single time they're resold these portfolios, they get smaller and smaller and smaller. So, like smaller companies like us, we're able to pick up these loans usually in the chain, like the third or fourth time it's being sold. So we're able to kind of cherry pick and go after little portfolios of like 20, 30, 40 notes at a time instead of purchasing like 800 notes that which we don't have the firepower to do. So,
What are the chances of you guys purchasing like a big portfolio, like you mentioned earlier, like a 90 plus loan, right?
mhm.
And what are the chances of those loans to where it remains non-performing? Because your goal is to try to get it to be performing again, right?
Yep.
So,
So we have multiple exit strategies for each scenario. So the first scenario is the preferred one, which it's non-performing. Let's say a borrower hasn't made a payment since 2012 or something. Um, what we do is when we pick up that loan, when we purchase it, we reach out to the borrower. We try to do some foreclosure alternatives with them. Our main our end goal is to do what's called a loan modification. And with a loan modification, we can usually offer them, say, hey, you haven't made a payment in 8 years. There's all this accrued interest, all these legal fees, all these late fees that have accrued. What we can do is we can reduce your interest rate. We can waive some of these late fees. We can waive a lot of this accrued interest. We can reduce your principal balance. What's going to work for you as far as a monthly payment? And as long as it hits our goal return on investment, we're willing to do it, and we're willing to work with the borrower to get them to restart their payments. And then from there, once they restart their payments, we can either hold on to it for cash flow, or we can flip it to another investment company or another investor that likes to purchase performing loans. So that's kind of how it's it's pretty much the same thing with flipping houses. You purchase it as a distressed asset. This non-performing loan is a distressed asset. You force the appreciation of the house through doing a renovation. You increase its value. We increase the value of the note by doing a loan modification and getting the payments restarted. And then you flip out of the house. Whatever the ARV is. You bought it for 180 and you sell it for 250. So we bought this loan for X amount, and we sell it for X amount as a reperforming loan. So
okay, so before I ask you the next question, I'm gonna do a little bit of housekeeping. So we got like more people that just logged in. Welcome to the live stream. Today we got Saim Chaudhry here talking about flipping notes. If you guys have any questions for us, make sure you guys put them in the live chat so that me and Saim could answer them, because I know we're not talking a lot about real estate today, but if you guys have real estate question, I'm a real estate agent. Saim is a real estate investor. Used to be. Now he's flipping notes. But I'm pretty sure he can still answer some of your questions if you guys have some. So
that still
make sure you guys
qualifies as
go.
a real estate investor.
What?
I said that still qualifies as being a real estate investor.
Yeah, yeah. I think
Type of investor.
I think you're still considered an investor, man. Cause it's real estate notes, right?
Yeah, exactly.
Yeah. So if you guys have questions for me or Sign, make sure you guys put them in the live chat so that we could read it. Cause I'm looking at it right now, and yeah, there's no questions yet. And I do apologize because we did start the live stream late. That's my bad, operator error. So I do apologize. Okay. But okay, so my question for you, Simon, is when you convert these non-performing loans that you just purchased into a performing loan, do you guys ever sell it back to the big banks like Wells Fargo, Bank of America, or so forth?
That's very rare. I haven't seen that done in the market, and obviously we don't have access to these big banks. They're not going to talk to us because we're smaller. They only deal with big, large hedge funds with, millions and millions of dollars, hundreds of millions of dollars of assets under management. So those are the people that they sell and buy notes from. Not really like smaller investment companies like us. But yeah, you could, in theory, you purchase a note from a seller, you get it reperforming, and if they're looking for performing and reperforming notes, you could, in theory, sell it back. I don't see a problem with that. I just haven't seen it in the market very much.
As long as the big banks or the big boys are interested, right?
Yeah, yeah. Their
Got it.
main goal is to originate the loans, make the fees, and then sell them off. So, yeah, it's you could probably sell it off to the second or third guy that purchased and sold it. I doubt the big bank would want that note back again, but they could. I mean, nothing's impossible.
Right. Okay, we got a question here from Toki and Chill Channel. Like your name, by the way, Toki and Chill Channel. They said, "Do you guys think the real estate industry will adopt crypto as payments?" I think they are because Bitcoin's blowing up, Dogecoin's blowing up, Ethereum's blowing up. I think eventually, because like I don't know, but have you seen this time? Like you're going to a 7-Eleven or so, and they say accept Bitcoin as payment.
I haven't seen that. I've seen vendors, not gas stations, but I have seen vendors online accepting cryptocurrency. Yeah, so I think cryptocurrency is going to be the future. So I don't know too much about it, but I can already see the movement towards it. Like I can see the craze and the hype. It's just like when social media blew up in the early 2000s, like Facebook and MySpace. I kind of see it heading that way as well. I could see the cryptocurrency blowing up right now. So
Yep, me too. But I'm not a pro at crypto.
yeah,
But
me neither.
if you guys need anything regarding real estate, though, I can help you. But crypto, oh man, wrong channel. I'm sorry.
Yeah, maybe homeowners will start taking Dogecoin. I
Right?
see that.
Instead of bidding $20,000 above asking, I'll bid two Doge coins on
Yeah,
top.
exactly. Yep.
Okay, the next question is from Mr. New Money. What's the percentage of these non-performing loans performing after your company buys them? And how do you know which non-performing loans to buy?
So I'll answer the second question first. When we receive a portfolio from like a broker or a seller of loans, let's say it's a portfolio of like 100 loans. What we do is we underwrite every single loan. We look at the asset that it's secured against, this, if it's a single family residence, commercial property, vacant land, whatever it is. We look at that asset, we value it. We get BPOs from brokers. We have brokers that go out and take pictures of the property. So that's the first step. The second step is, since we're purchasing notes that are non-performing, that are in second position and junior position, the most important thing is to see what the CLTV is. The CLTV is the cumulative loan to value. So I want to know what's the balance of the senior, how much do they owe on the senior, what's the balance of our second loan that we're about to purchase, and then what's the value of the property. And so we usually try to stay under like 65 to 60% CLTV when we're purchasing a note. Does that make sense? I can see the look of confusion on your face.
I'm hella confused, dude. You're speaking
Okay.
like a different language.
Yeah. So do you understand CLTV or cumulative loan to value?
No.
Okay. So we talked about senior loan and a junior loan, right?
Yep.
And I'll give you some numbers here. So let's say you have a house that's worth $100,000. Your senior loan, you owe $25,000 on it. Okay.
Okay.
The LTV of that senior loan, the loan to value, is 25%.
Got it.
The second loan is also $25,000. The LTV of that is 25%. The CLTV would be 50%. You add up all
Mm.
the loans that are outstanding on the property, and then you divide it by the property's value. So we like to stay under 60% of CLTV when we're purchasing a note. That way, we know that the house is equity, the property is equity. So just in case we need to foreclose on it, we won't have a problem selling it. It wouldn't make sense to purchase a note where the CLTV is like over 100%, because that means we're not going to, if we have to foreclose on it as a worst case scenario, we're not going to get all of our money back when
Mm.
property at auction.
So, question: because you also still do real estate deals,
Uh-huh.
let's say you buy a non-performing loan,
Mhm.
and it gets to the point to where you might have to foreclose on it. Have you purchased properties from your own portfolios that you purchased as a non-performing loan before and flipped it
We've done foreclosures before, yes, where we have renovated the
from
property.
your own loans that you
Yeah,
just purchased?
yeah. So we purchased a note. The borrower doesn't want to make payments or anything. They don't work with us, whatever the case is. Maybe they're deceased. We've had that scenario before too. We end up foreclosing on the property. Now we own the property. We can renovate the property, or we can just sell it as is. So that's another method of getting property ownership, is through notes, which is a very neat thing about investing in loans.
Is it harder? Okay, so let's say I'm a real estate investor and I wanna I don't. I want to skip all of the competition because, like you said earlier, there's the market's just so saturated right now, and it's just so hot. There's investors in every corner buying auction homes. Too much competition.
Mm.
Would you say that me buying notes is probably a better strategy to flipping homes than going straight to the property owner, like a traditional real
Purchasing
estate investor would do?
purchasing notes is a whole different industry, and you would really have to learn. You would have to make the connections first of all to purchase those notes in the first place, to purchase those portfolio of notes.
Such as what?
If you're purchasing portfolios, then you would have to make connections with sellers, and those sellers are not very easy to find. But you could do is you could purchase one-off notes. There's websites where you can purchase like one-off notes, like you could purchase non-performing notes, which is it's not part of a portfolio or a package. It's just like it's one private lender selling their note that's not performing anymore. You can do that. It's a Google search will show you some websites where they have some marketplaces for that. So yeah, it is another option, but I would say you be very careful because there are a lot of laws. You would have to be familiar with servicing laws. You would have to bring on a servicer to service your loan, and then if you want to do the foreclosure, you would need to be familiar with the foreclosure laws as well. And there's judicial states versus non-judicial states for foreclosures. So it's not as easy and straightforward. And if the borrower starts making payments again, borrowers have rights too, and you shouldn't. I don't think. I mean, a lot of companies do this. They'll go and invest in notes just to foreclose. That's their main concern. Our main concern is just getting the borrower to reperform. That way, we can hit our return on investment. We can hold on to that cash flow, or we can sell it as a reperforming loan. So our main goal is not to take ownership of the property. It's just it is one of the exit scenarios if it comes to that.
That's good. That's like a win-win situation, right? The owner gets to keep the home, and you guys get to make some money.
Yeah, and we hit our returns. Yeah, and then we have some options. We can keep it for cash flow, or we can flip out of a note and sell it at a profit.
Would you be comfortable sharing how many loans you guys are actually that you guys actually own right now that are cash flowing? What's the percentage that these loans do convert to where you guys are cash flowing? Because obviously it's not all sunshines, right?
Yeah, so that plays into the CLTVs. So if a borrower has a lot of equity, that's why we go after low CLTVs. If a borrower has a lot of equity, there's a very low chance that they're just going to let their house go to foreclosure.
Right.
Versus if the borrower is underwater, why would they be motivated to restart payments on their loan if they're like 150% CLTV? That's they're underwater at that point. I'm not saying that doesn't happen, but it's just not. They wouldn't be motivated to do that. So a lot of that comes into that. So we have a very good success rate of getting loan modifications and our loans reperforming because we're so stringent with our CLTV criteria. We only like to purchase. We only pick out of a portfolio of 100 loans, we might pick out 20 loans, and out of that, we might get our bid accepted for 5 of them. So it's a very low rate of loans that we'll actually purchase out of a huge portfolio, but but it's good because our success rate with getting loan modifications is very high. I would say probably in the 90%. We've only to date, I think we've only foreclosed on maybe a handful of properties, maybe like 4 or 5. So.
I think that answers one of the comments in the live chat from Irv Green. Are homes currently being foreclosed on during these times?
Yes, they are, and it depends on the state. It depends on the county. There's different counties where foreclosure auctions are still taking place. You can still evict people. There's other counties and other states where they're just on hold. For example, we have some New York notes where we're trying to get foreclosure action done, and it's not happening. There's a moratorium on it. So some
Just like
states,
California.
yeah, some states are more stringent. Some states are very lax and cool about it. So
Your lighting is very dark now all of a sudden. Did
yeah,
something happen?
yeah, it's the sun's going down. That's what.
Ah, that's what it is. I'm like, how come my lighting is still the same, but your lighting just changed?
How's that?
There you go. I can see your face now. Earlier, like, all I saw was your teeth and your eyeballs.
Yeah, the sun's going down.
Oh yeah, but okay. So then, what was I gonna ask you? So with everything going on, by the way, thank you so much for the questions. Again, if you guys have other questions for us, put in the live chat so that way me and Simon can answer them. If let's say you guys are you guys investing more in notes in California locally only, you guys are investing everywhere.
So about 3 months ago is when we started investing everywhere. Um, but I will tell you, I really prefer California because I know
Why?
the market in California. I know, this property is in San Bernardino, Riverside, LA. I know what it'll sell for based on the neighborhoods. It's very hard to value a property like if you're purchasing a note out in like Ohio or Oregon or something. So we like to stay in California, but the prices are going to be a little bit higher for California notes. And then you also have to learn all the laws of each state, bankruptcy laws, foreclosure laws. Is it a judicial state? Is it a non-judicial state? Um, can I just take this property to auction? Like in California, that's what I love about California. It's a judicial state, or sorry, it's a non-judicial state. So other states that are judicial states, like New York, you have to actually file a lawsuit, and then there's procedures. There's like a long timeline. There's mandatory settlement conferences where you have to sit down with the borrower at the table and come up with foreclosure alternatives, which is good, but it really drags out. Like it could take 3 years to foreclose on a property,
Right.
whereas in California you could foreclose on a property in 3 to 6 months. So I really prefer California, but we did start branching out to other states lately in the last 3 months.
So you've only been doing this for like about 2 years now, right? Give or take.
Mhm.
What would you say? Like, of course, you didn't know anything about it. How did you learn about all these things about regarding notes and all that? What did you
Well,
had to
for me,
learn?
I was very lucky to know these two investors that they had already done some work with notes. They're very savvy. They know the law. They have a huge fleet of attorneys, bankruptcy attorneys, foreclosure attorneys. So I've kind of picked up everything from them. But I would recommend if somebody's looking to get into the business, Bigger Pockets is a great place. And I would approach it the same exact way as if you wanted to learn how to flip houses or any other niche of real estate. Find a mentor, find somebody that's doing what you want to do at a higher level than you, and add value to them. Learn the business from them, and then go from there. It's the same exact thing investing in learning how to invest in any other niche of real estate. This is just another niche. So,
Do you see yourself doing this for a long time? Because obviously you've been doing it for since 2019, so you're probably not going to be transitioning full time back into investing anymore, right? Purely.
like I said, I'll look at a deal. I don't think I'll ever stop looking at deals. I love deals. Real estate deals. But it really depends on the market. I mean, 5 years ago I would have said I'm never going to get out of flipping, but here I am. So it depends on the market, and you just got to adjust with the market, and you got to evolve with it. So if this is the niche that's working for us right now, it might not be in 5 years. Who knows? We'll see how it goes.
Do you do you mind sharing some numbers? Like on average, how much would you say you make on a good note that you just flipped?
It's really it's very difficult to because the numbers are all over the place.
Right.
Notes a note could be originated in 1996 and have a few years left till it's paid off. Another note could have originated 10 years ago, and the numbers will be completely different. So I'll give you one example of a note that we're working on recently that's very easy. It's just like it's a black and white case. We purchased it for 75, and not all notes are going to be this high profit. But we purchased it for 75, and the payoff with all the accrued interest, all the late fees, all the legal fees is about 150. So, and this borrower just wants to refinance. He has enough equity in his house, so we're just gonna, do a refinance, and we'll get paid off our balance, and he'll have a new lender with a lower interest rate, and he'll pay our note off. So that'll be like a very quick flip of that note. But not all notes are like that. So
Got it. There's a question here from Irv Green. Do you take money from outside investors?
yes, absolutely. That's how we're able to grow. All of our portfolios we've done syndications for. So we, instead of using our own money for every single portfolio purchase, we just like any other fund is set up, any other hedge fund, any other, whether you're investing in stocks or multifamily or, whatever it is, Um, if you want to grow, you use other people's money. It's called OPM, Warren Buffett. Look it up. So yeah, we raise capital from other investors and we give them a preferred rate of return. We do equity splits, and that's how we're able to look at bigger and bigger and bigger portfolios every time we purchase a loan portfolio.
Earlier, you mentioned that there's big players in there, right? Bigger banks that will probably have bigger portfolios, and you guys are considered little guys, right? How
Yes.
long would you say it'll take for you guys to be considered the big boys?
I wouldn't have a timeline on that. I would say we're headed in the right direction by investing nationally now instead of just in California. And also, we've just recently started looking at senior liens, not just junior liens. And we're also looking at performing notes now. So we're creating different buckets of investors depending on what their goal is. If they want to just have cash flow and they're not so aggressive, we'll put them in a bucket of reperforming loans or performing loans, and we'll raise capital and build an entity out for that, and just purchase a portfolio of performing loans. Obviously, the returns are not going to be that high as if it was a junior loan pool with non-performing loans, because those are a lot more risky, and with risk comes more reward. So it really depends on the investors that we have and their end goals and what their goals are. A lot of people like to invest in notes with their 401k or their pension plans, and they just want to have a safe, secure asset that's bringing in cash, and they don't want to have to deal with any of the risk. So we can use those investors to build one pool, and then we could use the other guys that are a lot more aggressive, that don't mind the risk, and build out another pool with that. So
So when you were investing, you were flipping houses. You work with a lot of like wholesalers. Is there like a wholesaler or bird dogger you may call in the notes industry?
not so much. There are brokers. There are loan brokers, and they have connections with loan sellers, companies that sell loans, and they might be like, in the chain of it's originated from the big boys like Bank of America to Wells Fargo. They'll sell off the loans to big hedge funds with, hundreds of millions of dollars in assets under management that are worth hundreds of millions of dollars. They'll sell huge portfolios of like 5 to 800 loans to them, and then they'll break it up, and in a few years they'll sell what's left into other smaller portfolios, and then it just kind of gets tiered down from there. So usually we're like the third or fourth in the chain of purchasing, and that's where you can find good brokers, you can make good connections. There's also websites like debtx.com is a big one where you can find portfolios for sale. You have to go through their accreditation process. Another big one is Mission Capital. You can sign up for there, and then you have to go through their accreditation process as an investor, and then they release pools out to you through email and stuff. But if you're just getting started as like a solo investor, I would recommend Googling like other websites where you just type in something like non-performing note for sale, and you can find these websites, these marketplaces where you can buy one-off notes, like just a one note, in that's secured against one property instead of having to purchase huge pools of notes. So, and we still do that all the time as well. We don't just bid on portfolios. We'll look at notes that are being sold just by one single investor, like a private investor. Like Chia gave his friend a loan to purchase his property. So Chia did a deed of trust and a note, and he secured his loan against the property. Now Chia wants to sell the note 5 years later. He wants to get paid off. He'll put it on this one of these websites, these marketplaces, and whether it's performing or non-performing, it'll show that. Maybe Chia's
Wow.
friend stopped making payments and Chia's fed up. Chia doesn't want to foreclose. He doesn't have time for that. So he just puts it for sale on one of these websites. Or maybe Chia has his life has changed and he wants to buy a boat now. So he wants to get paid off, but his friend can't pay him off right now because
Mm.
he's only built 5 years worth of equity. So Chia will put up this note on a marketplace as a performing loan. So there's a lot of different marketplaces for purchasing and selling notes.
You mentioned earlier that you guys are starting to do more like performing loans. Does that mean you're gonna be like a loan originator?
No, we don't originate loans. We will do performing loans. We have we haven't really purchased that many performing loans. This portfolio that we're looking at now, it has a lot of performing loans. But again, it's based on the type of investors that we get. So if there's investors that just want, cash flow, stable cash flow from day one, um, then we'll take those investors, we'll build a pool of them, and we'll go out and use their money to purchase a pool of performing loans. There's other investors that are a lot more, they want the risk, they want the return, they want the reward. They're willing to wait 2 to 5 years to start getting payments. So they'll go after non-performing loans with us, and we'll create a whole separate batch of those investors and bid with their money on other pools that are, non-performing, for example.
Are you are you taking on students right now, like mentees?
I personally don't have time, but I'm always open to answering questions. I don't think I have enough knowledge right now, like to be in that position of mentoring anybody. And I got very lucky with these two investors that I've known since like 2010. They hit me up and they said, "Hey, you want to work with us? We're doing non-performing notes now." So I was like, "Okay." And I was just getting out of, home flipping because it wasn't very consistent for me towards the end. The deals had started drying up. So I was like, "All right." And this is one of the guys that I got started in real estate with. I mean, Billy and Heidi, obviously, my brokers. And then this was a third guy that helped me get started in real estate. So I was very excited to learn from him. So, but yeah, I can answer questions. You can put my email out there. I can text people back, whatever. Um, if I have the knowledge about it, I don't mind, sharing. So,
For sure.
but I don't think I'm
Yeah,
in to like actually mentor anybody.
yeah. You don't want to set up the wrong expectation, right?
Yeah.
Josh says, "How do you become an investor and what's the return?" Josh, I'm not quite sure what you mean by that. Also, what's the requirements to becoming an investor? I
If he's talking about loans, investing in loans, there's no requirements. You can, like I said, go to one of these marketplaces on Google, you know, purchase loans, purchase notes, purchase non-performing loan, and you could just go on there. If you have some money, you could buy it. You don't need a license. You don't need to be like a lender or anything to get into the note business. Same thing with flipping houses. You don't need to have your real estate license. If you have money, or if you have connections where you can raise money and you can find deals, great, you can go for it. You don't need to have, there's no criteria.
hopefully that answered your question, Josh. Another one from LG. Yes, it depends if the sellers take crypto. Oh, I think he was probably answering the other person's
Uh,
question regarding crypto as payments. So right now you're doing this full time. Do do you would you say that this is 100% of what you're doing right now? No more flips at all?
this is yeah, 110%. It's very time consuming and it's a new industry for me. There's a lot to learn. You got to learn foreclosure laws. You got to learn bankruptcies. You got to learn how to read bankruptcies. You got to figure out how to underwrite loans when you're looking at a portfolio. I got to, talk to borrowers where we've already purchased their loans and coordinate foreclosures with the servicer, try to do a loan modification with them, write up the loan modification paperwork, make sure the loan modification paperwork is compliant with state law, depending on which state we're doing it in. So there's a lot to learn. There's a lot of, it's very time consuming. So yeah, I don't really have time for anything else at the moment. So, but it's been very rewarding. I've actually really enjoyed it. And it's awesome when you do a loan modification with a borrower and they're very happy and ecstatic to get their payments restarted. A lot of times these loans are sold behind the scenes like two, three times, and the borrower doesn't know who the lender is, or they can't get a hold of the servicer. They don't know who the servicers are anymore.
Don't
So
the banks have to notify the borrowers each time it transfers or gets
they
bought out?
They do, but a lot of things get lost over time. You don't know like what's going on, and people lose their jobs. They go through hardships, and then once they're ready to come back and start making payments again, that they don't know where to go. Your loan has been transferred out, blah blah blah. So they're a lot of times they're very happy to hear back from us, and they know that they have an obligation. They know that they have a responsibility. They just didn't know where to go. So they're happy to hear that, hey, my loan is still alive, and I know who to make payments to now. I don't have to worry about my loan being in limbo land, and possibly losing my home to a random foreclosure. So
How often do you guys pick up these non-performing loans again?
I'd say we look at like 12 to 15 portfolios per year. And then we possibly purchase about like, I mean, last year we probably purchased like 50 to 75 loans.
Wow.
I think this year will be a lot better. We're already looking at bigger portfolios. Where this year we've already, started branching out to other states as well, and then also getting other investors that want to do performing loans instead of just non-performing loans. So I think we're headed in the right direction of growth at the moment. So,
Got it. Got
but
it.
it's also good to keep this. It's also quality over quantity.
Right.
So it's like if we grow so big and so fast, we're unable to touch each borrower on a personal level.
Mm-hmm.
Then we're just another one of the players where we're just like a foreclosure boutique. We're just foreclosing on people's homes, and we don't want that because it's not a win-win situation. We don't hit our returns, and people lose their houses, and that's not good. So we like to keep it smaller company, quality over quantity, where we can talk to each borrower. These borrowers, they have my cell phone. They can text me,
Oh,
they can email me. They know where to get a hold of me. They can call me after hours, and I'll talk to them. And so they like that a lot as well. Instead of having a 1-800 number where you can't get a hold of a human,
yeah.
and you have a looming foreclosure over your head, it's very frustrating. So it's good. It's quality over quantity as well.
That's pretty cool. All right. Well, man, it's 8 o'clock, dude.
Yeah, you got a date.
I do. I got a date night. But hey, thanks, Chi fans, for joining us today. We'll be back next week with a different guest. But today it's with Saim Chaudhry. And if you guys are interested to like reach out to him because you guys are curious about getting into flipping notes or anything like that, I'll put his email in the description of this video, and you guys could just bombard him with emails.
Yeah, and if there's any investors out there that want to invest in notes,
Syndicate, right?
yeah, if they want to invest in notes, we're always looking for new investors as well. So feel free
Cool.
to reach out.
All right, well, that'll be it. I'm gonna end the live stream here. Thanks so much for coming in, man. Appreciate you.
Thank you for having me. Thanks,
Yeah,
Gia,
man. Next time we gotta do a part two, okay?
for sure. All right. Bye.
Later.